Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS, an options analytics platform that is built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform, and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to look at the differences between SPY, SPX, and XSP, and why it's important to understand exercise risk. Matt, do you want to share your screen and get us started by going over last week's trade?
Absolutely. All right. So I think we did a iron butterfly in SMH. I did this for another show too, so I have two similar ones on, but it's about break even right now. And then from prior shows, we did a cheap call and puts show. So let's just kind of look, like CRM was one. We're down a little bit in there, and we're up a little bit in WES. It's up 2% today. We're long. We have a call on there, and the other ones are about break even. So doing all right. Pretty nondescript trading week, Tyler.
Gotcha. All right. Well, thank you. So this week we're going to look at SPY, SPX, and XSP. Would you mind going over, for me especially, because I don't really understand the difference between those three symbols. Can you briefly go over what the differences are and why it matters?
Yeah, and you're not alone. So, but it's extremely important. So, I hope people can understand this, especially if they're trading, the zero DTEs or taking trades up into expiration. Those are the big differences. So, SPY, everyone knows SPY. It's an ETF. It has American style options on it. People don't usually say American style options because most, probably I'd say 95% of options are American style, which means it can be exercised at any point in the life of an option. So what that means is if you get exercise, so to speak, then if you have to, in order to get exercised to you have to be short an option. So if you are, it doesn't matter if it's in a spread or what. If you're short a call, you'll be responsible for stock. If you're short a put, you'll be responsible for long stock, short stock in the call. So and that's somewhat traumatic for people, but usually you just able to buy it in the morning, and it's not a big deal. However, it will result in a margin call, and sometimes you won't be able to trade that day if you don't have enough money in your account. So again, SPY, American option, exercisable before expiration. Now let's talk about, there are symbols like SPY that are not exercisable before. They're called European style options. European style options cannot be exercised before the exercise date. And the most famous one is SPX, but a lot of traders don't trade SPX because it's such a high dollar amount. SPX right now is 5,466. So people can't really afford that. It's 10 times that of the SPY. SPY is high enough as it is. But so this is a European style option, and it is not early exercisable. It exercises into cash. So now let's talk about at the time of exercise, 4 p.m. on Fridays, or every day, but at 4 p.m. Is when these exercise, and they publish an amount. And that's where your exercise. If you're in the money $1, you'll get $1. And now with SPY, however, if you're in the money, you will get exercised with the actual deliverable of option there. So it's not cash settled like SPX is. It's settled in the underlying. The underlying here would be for every contract it represents 100 shares of SPY. So that's a big number, $54,000. So those are the differences. I'm going to get into a little bit more what that means for option prices and everything. But does that make sense so far, Tyler?
So far, that makes sense. So I do have one question. On an American style option such as SPY, if you have a spread and you have a short leg, but that's balanced out by the long leg, can you still get assigned the short leg? And do you have to deal with that risk, or how does that work?
So let's just say at expiration that you have the equal number of longs and short that finishes in the money. In that case, you don't have to do anything. You could let it expire in the money. There's still risk, which we'll talk about later, but that offsets. Now, if you have a spread, they're both in the money, but it's not expiration yet, you could still get exercise. You'll still be hedged, so to speak. It's actually sometimes a good thing to get exercise because all the optionality is gone from it. But still, it's a headache, and it requires you to go buy the stock, and sometimes you get a margin call if you don't have enough money in there. So does that make sense?
Yeah.
Okay, good. So another problem, though, is even at expiration, when you're watching the price of the stock, both your long and your short go out in the money, so they both get exercise, right? So you think you're fine, right? But another problem with American style options is the holder of the contract has until, I think it's like 5:30 now. So an hour and a half Eastern, hour and a half after expiration to exercise, to put in the exercise advice to the exchanges. So the exchanges get it, and then they do the exercise if it's not automatically exercised. So you could say, don't automatically exercise it, or exercise something that wasn't automatically exercised. So do you get that distinction?
Yeah, that's interesting. So they can wait until after the market's closed to determine whether or not to exercise it.
Exactly. And as you know, these stocks are now trading after the options expire. The stock is still moving around, and things can happen. A lot could happen in an hour and a half. And so that's a big deal. I mean, it's a risk out there that I think a lot of people don't truly appreciate. So do you get what the implications of that are? And I should also say that the implications are not just in me saying it. The implications are out there for the market to see. Meaning, if you look at XSP, which has about the same price as SPY, the SPY options with minutes left in their life are a lot more valuable. They're a lot higher priced than XSP that for sure exercises at 4 o'clock in a couple minutes, let's just say. And SPY, people can buy them and own them just to see if anything happens in the hour and a half after. Mostly it doesn't move, but something could happen. So do you get that?
Yeah, that's really interesting. So the risk of assignment in American versus European style options is heavily reflected in the option prices, say, 15 minutes before the close.
And even right at expiration, you're going like, what's happening? Like, why aren't these decaying to zero? Right? They're going out at 5 cents or 4 cents or 3 cents. And you're like, I should be getting my money. Why aren't I getting filled? Even if you want to trade out of them, right? So
Right.
This is an important lesson for people. And because you do want to trade out of them, but often you can't trade out of them at favorable prices because people know that there's value in them and can exercise them. And now, retail can exercise with a broker, or you should talk to your broker about that beforehand before you try to do it. Just what's the process of it. So, but typically retail traders don't do it, and we used to do it all the time as market makers. but we don't do it as, or I don't do it as a retail client so much.
Gotcha. So this might be a silly question, but is this only the case for SPY, or is this the case for other symbols, or is it just ETFs, or what?
Yeah. Okay. So good question. I didn't clarify that, but yeah, it's for every symbol. And now let's just go through some of the index options, like IndX. No one trades because it's so big, but so some of those are, and VIX is an index option. Or index with options underneath it, I should say. But most, like I said, 95 or more percent have this American style that have risk. And so this is why you want to be careful with it. You want to trade out of it mostly beforehand, unless it's way out of the money. But there's still, tales of woe for even way out of the money. They just said, so far out of the money, I don't want to waste my money by closing it out. And, lo and behold, the stock moves. And, you could lose a lot of money. So, yeah, it's every single option that isn't an index.
Gotcha. And do other symbols have sort of like an XSP variant of them, so that you can, if I'm very wary of this exercise risk, and I want to trade XSP, is there an alternative symbol for other ETFs or stocks?
Yeah. For example, only the big ones. So like the NASDAQ NDX also has a smaller one. It escapes me. I haven't traded that, but Russell RUT is, because IWM is the ETF that is American, and Russell RUT is the index, and there's MRUT, the mini Russell, that also has options that you can trade. The QQQ is a dangerous American style option, but NDX is the one, and the mini, again, the name escapes me, is the equivalent that is a European style, so you won't get these exercise notices.
All right, that helps a lot. Is there any way to search for these European style symbols or anything like that in ORATS or any other place?
Yeah, so you can in ORATS. If you go to the stock scanner, you can look for the asset type that is only indexes. That's 4. And so then these come up: BKX. Oh yeah, I should have said the Dow, the DJX, NDX, SPX, and UTY. So those are the main ones there. And then all the rest are stocks again that you could go look for. And I think the next thing to do is to talk about what we see in similar back tests with XSP, again with a very similar stock price to SPY. So one of the strategies that I use that is extremely important to not use SPY is a short-term short strangle. So what you're doing there is often I like to close them out, but like I was having trouble. I did it for SPY on a couple trades, but I was having trouble closing out those trades at what I thought were reasonable prices because of the exercise risk after the close. And so if you compare a straddle selling, these are the inputs that I tend to use for the way out of the money. If you compare an XSP, for example, with an SPY, and you can see the similar setups here. You'll see that the SPY has a lot higher Sharpe, 1.57 versus under 1, and a lot higher annual return. And again, this is all because when you're closing out a trade, in XSP, they will expire worthless, Whereas in SPY, there's still some value to them. One of the things so we're going to start adapting our backtests to allow to simulate trade. Instead of right now, at expiration we do the expired amount, the intrinsic amount, and what we're going to start doing is saying, well, at expiration we're going to take what the value is of the option, what the option goes out at, because as we've been talking about, SPY goes out, a worthless option goes out with a bid on it a lot of times, and so and it really does change the returns pretty dramatically, as you could say. That's a big change in XSP versus SPY. So again, this is one of the things that you need to look out for in backtesting is the real world experience. In this case, trading very short term strategy is really underestimating the problems that you could have in SPY with the value of the options left over. Does that make sense, Tyler?
Yeah, it's really interesting to see it in a backtest form and how the Sortino ratio is higher in one versus the other. You can really see that difference of American versus European style options reflected in that indicator.
And so it's another lesson, right? There's a lot of lessons here. The first being, be really careful with American style. The second, be really careful backtesting American style, because that's hard to model. It's hard to model what is the value, what's the true value of an option going out in the money, because if there's news after the close, or if there's something going on, you don't necessarily know about that in the backtest.
Yeah, and since those prices, if the option's expiring in 15 minutes, and you said those prices are non-zero,
right?
Are you seeing those prices? You've been trading for a lot of years. Have you been seeing those prices increase as the years have gone on, or like are more and more traders starting to choose to exercise their options after the close? Is there a trend in that?
No, I think it's been steady. But it just really depends on, if you're in a volatile market and there's news coming out after the close. I would say though that there is more trading after the market close. When earnings comes out, if you're in an earnings season, those earnings after the close typically come out in the first few minutes after market close, and that's going to move the market a lot of times. So I would say at certain times of the quarterly earnings cycle, it can move the markets after the close.
Yeah, I think it's definitely important to recognize that, and because I've seen a lot of brokerages start to come out with after hours trading for retail investors, and I think that's going to impact the option prices 15 minutes before the close.
Yeah. So let's look at this is my what I call the safer strangle selling is I sell a strangle, but I have a long term and a shorter term. So I might sell the 2, 3, or 4 day, and I'll be long the 1, 2, or 3 day, and then long a very long term option strangle. So I actually have like 2 longs against it, but there's a lot more. I make money on the decay of the one that's of this what we're looking at right now, because it's and it's only like you could see I put SPY in here. I usually just trade XSP for the reasons that we've talked about. So these are similar. Similar. I'm wondering if it's going to be kind of hard to compare because the prices are different, but you can see here it's kind of mixed, but it's mostly SPY that's coming out as the kind of top, maybe overvalued short-term options here. And as a matter of fact, I should probably just do one, see if we could get, I don't know if we'll be able to find anything on the actual day. There aren't too many options out there right now, but And this is a little bit difficult to do for our purposes, but I think that this will be the trade that we'll do. And with just knowing that, just everyone knows that this is not usually done alone. But we want to put on a trade. So here's a July 5th trade so that we could put on for the people in our paper trading account, Tyler.
All right.
So stocks at 547 for XSP, 541, 6 down, 6.5 down, and then 7.5 up. So the implied volatility 10 and 8. That's the skew that we're seeing. The SMB values are pretty much right on the midpoints. There's some long deltas to these just because the volatility is higher in the 541. So this will be the trade that we'll put on, and I usually could give them a couple cents, and then force it.
So this is typically not done alone, you said, right? So
Right.
Only if you own the stock already.
And why don't we just do that? Why don't we show the long that I do too? So I'll take out SPY. So the long that I do is a cheap strangle, and you can see it right here. It's only 6 cents. So 5 cent. So our SMB value is 5 cents. So we'll give them we'll give them a penny on that one, and then we'll force that.
So if you wanted to do these at the same time, because most traders, most people watching this show aren't going to, have one on already. Could you combine those two scans in the custom strategy builder?
You can, but it's a 4-leg that's not, it comes out as a kind of a weird scan. I do that sometimes, but I end up just trading it, the long first and then the short. And then, so now, and I should say this, so let's do the long-term one. So here's long-term only. This is both right here. But, this is the very long-term one, 90 to 222 days. And, you could tell how far out of the money they are. I'm going to go with the October is 215. So it's worth 216. So we're going to have to give them probably 220 to trade this. And so force that. And okay, so now we have the full complement on.
Interesting. So would you be able to see our combined risk in the risk analysis in the sidebar? If we
that's a good point. It is a little bit difficult to see. I'm going to take a picture of this for next, so I remember to do it next week. So I have to look it up again. Oops, I didn't want to do that. So the risk. So let's go look at XSP. So there's the long-term one. The problem is the long-term one, it doesn't compare well. So let's just, I'll say it that way. So let's just look at the short terms first. So this is the long straddle with the short straddle. So it's essentially it's like an iron condor, except for we're long the shorter dated ones. Another reason you want to have the longer dated ones on is for margin relief, because right now you don't get margin relief if you have if your long is shorter dated than your short. I don't know if that makes sense, but you want to have at least one that's longer dated. So my margin, our margin buying power isn't too bad. So this is what it looks like, and this only goes from 535 to 559. So now I want to clear this out and just look at the other one, the longer dated one. So instead of 559, this one goes down to 437. So the whole skew is a lot. This is really wide, so it's really hard to see it. And if I were to then click on the other ones, it doesn't look right. So what I end up doing is I say, well, let's just look at the shorter term ones together. And then I know that, how much I would make at certain points in the longer one. So it's a little bit difficult to risk manage with all of these, but you should also know that if the stock were to move, that the volatility would go up and your puts would be a little bit more valuable.
Gotcha. Okay, so we do have a slider there, right? That what if IV increases,
right? Yeah.
Is
So
that
let's just what I tend to do is let's just look at let's look at the long and short dated one first. So our worst point is right about 535, right? There's nothing too bad up here, but 535, maybe we lose either $500 or today, if it went down there, we'd lose $300, something like that. So let's look at 535 only on the longer dated one. Now you can tell it's kind of a smile. So 535, we make $100 or something like that, right around here. So and if IV goes up, which it will, then we make, so I'm just kind of mousing over 535. So then we make, this says about $500. So that's a break even. Do you see that?
Yeah.
So that's what's going to happen. So even though you have, a fair amount of theta coming in, so our theta on this is, basically very low, $4 of theta. Let's look at the theta on the other one. The theta is how much you should make each day on your, so the theta is on this one is $24 a day. And, and then if you put this in the shorter one, then it's, it goes down to $10 a day, but still $10 a day. And there's just a couple on the other one. So you still get a very good theta from the short strangle that you have. And you're going to get, because you could only lose $6 on this one. And if you get the full boat, probably you get $50 on this one.
Right. And just to clarify, you're saying that IV is going to go up because we're trying to see what happens if the stock goes down 5%.
Yeah, that's our risk. And we saw with the short term, our risk is on the downside. But if it goes down there, then our long strangle is going to pop. And there's a lot of vega in these puts.
Gotcha.
Yeah, so that's a trade today, and that's the it's also why I like, it's not as popular, but XSP. That you now hopefully understand why I like to use XSP for this short-term trading, especially on these, around the money.
Yeah, it's really interesting, the difference between those three symbols, and very important to understand the exercise risk. And I think you did a great job explaining it and demonstrating the differences in, the payoff and the back tests and the scanning. It's all important.
Yep. Thanks, Todd.
Yeah. That about wraps it up for today, unless you have anything else, Matt.
No,
we'll be back again next week. Thank you again, Tradier, for hosting, and thank you, Matt, for explaining. We'll see you guys then.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.